Hi guys, welcome back to another video. In this video, we're going to be talking about the $4.8 billion financing. We're also going to learn how private credit is beating banks in 2026. On the 25th of March 2026, Canyon Partners, a $30 billion private credit firm, is announced as the lead arranger of $4.8 billion unitranche financing. The borrower is Auctane. It is owned by the private equity giant Thoma Bravo. The purpose is a merger with the WWEX group to create an end-to-end e-commerce and logistics powerhouse. In 2025, private credit surpassed $1.7 trillion in the US alone. But here's the tension the headlines won't tell you. Private credit firms are not just winning market share, they're fundamentally changing how middle market deal making works. So the question isn't whether private credit is beating banks, it is how long the banks can afford to watch. Let's start with the situation. Accutane is a global leader in shipping and logistics technology. Its brands include ShipStation, Stamps.com, Shipping Easy, and Metapack. These softwares are the ones that power e-commerce fulfillment for millions of small businesses and multinational brands. WWEX Group is a major freight and parcel brokerage platform comprising of brands like Worldwide Express, Global Trans, and Unishippers, which serve over 130,000 customers and manage more than 70 million shipments annually. Thoma Bravo, which already owned Accutane, wanted to merge these two and create a scaled end-to-end logistics company with enhanced capabilities across the e-commerce ecosystem. The problem was that Thoma Bravo needed execution and speed. A merger of this size has tight timelines, tight regulatory windows, and competitive pressures. A traditional bank syndicate would take months to underwrite the price and syndicate. Thoma Bravo had another option already on the speed dial. On this page, we have the deal mechanics. The total financing is $4.8 billion, not in bonds, not in syndicated loans, but a single unitranche facility with one loan, one set of terms, and a single negotiation. The lead arranger is Canyon Partners, a Los Angeles-based alternatives investment manager founded in 1990. They specialize in credit-intensive strategies across corporate credit, asset-backed credit, and real estate. Thoma Bravo is the sponsor. They already owned Accutane and will own the merged entity post-closing. The transaction is structured as a traditional private credit direct lending deal. There are no public bond offerings, no bank syndicate roadshows, and no rating agency approvals. Just bilateral negotiation between Thoma Bravo and a group of direct lenders. The private credit loan was priced at 5.75 percentage points over the benchmark rate and was structured as covenant light. The financing includes a $4.8 billion unitranche loan alongside a revolving credit facility, with a total of 33 lenders participating, including Blue Owl Capital, Oaktree, and Goldman Sachs. The $4.8 billion unitranche loan flows from a group of approximately 33 direct lenders. The financing is designed to fund the acquisition of WWEX Group and to refinance Accutane's existing debt, replacing it with the new single facility. Additionally, Thoma Bravo plans to inject about $5 billion in the new equity and the combined entity to ensure sufficient cash flow for market expansion. On the return side, the structure is straightforward. Over the loan's 5 to 7 year expected return, operating cash flow from the merged business services debt. There is likely an amortization schedule, some principal repaid annually, with a bullet payment due at maturity or exit. The lenders expect to be repaid either through a refinancing or through the scale of the merged entity. Any residual value after the lenders are paid in full and belongs to the Thoma Bravo equity. Let's talk about the returns. The unitranche loans pricing is built on a floating base rate, the secured overnight financing rate. In early 2026, this sits around 4.5% to 5%. According to the deal terms, the private credit loan was priced at 5.75% over the benchmark rate. Add those together, and all in the cash coupon ranges from approximately 10.25% to 10.75%. But the coupon is not the whole story. Private credit lenders also charge origination fee, typically 1 to 2% of the loan amount, or $48 million to $96 million on a $4.8 billion facility, plus an exit fee of around 1% when the loan is repaid. When you factor in these fees and the relatively short duration, the total IRR for lenders land between 12 and 15%. Now, this is the part that most explainers miss, the incentives. For Canyon partners and the other lenders, the answer is yield. A 12 to 15% IRR in a 4 to 5% base rate world is exceptional. Moreover, by lending directly, they avoid the retrade risk of syndication. In a direct deal, the commitment is the deal. For Thoma Bravo, the borrower's calculus is quite different. Speed is the primary advantage. A traditional bank syndication would take 4 to 6 months to arrange. Canyon turned this deal around on a timeline that worked for the merger. Additionally, Thoma Bravo avoids public rating agency scrutiny. The merged company credit profile and the financial details of the firm remains private. Finally, the sponsor angle. Thoma Bravo is a large, sophisticated private equity firm with deep relationships in the private credit market. They know the terms, they know the lenders, and they value the flexibility that private credit provides for bolt-on acquisitions and future growth investments. Nothing in finance is risk-free. Let us stress test this deal. First, we have the underwriting risk. Did the lenders properly underwrite the cyclicality of e-commerce and freight markets? Shipping volumes are volatile. A downturn could pressure cash flow. Second, the sponsor alignment. Thoma Bravo's equity contribution is substantial, but equity sits beneath the unitranche debt. If the business underperforms, the equity absorbs the first losses. The lenders have that cushion. Third, and most significantly, the refinancing risk. The deal is structured as covenant light, meaning it does not include maintenance covenants. This is a double-edged sword if the merged business performs well. Thoma Bravo may refinance into the syndicated loan market, but if the spreads widen and credit market sees up or the business underperforms, there is no bank syndicate backstop. The lenders hold the loan to maturity. Now let's model a default scenario. Because the deal is covenant light, a 30% revenue drop would not trigger an immediate technical default, but persistent cash flow deterioration would eventually lead to a restructuring negotiations. If Thoma Bravo chose to not inject additional equity, the unitranche lenders can take control of the business through a debt for equity swap. The equity contribution would be wiped out completely. Lenders would recover whatever they can in a restructuring or liquidation event. This is the asymmetric risk profile of private credit. High yields, but when defaults happen, they happen quite fast. But the question is, did this deal work for all the parties? It's too early to judge the final outcomes, but the structure tells us where the advantage lies. The deal worked because the direct lenders provide Thoma Bravo with speed, flexibility, and execution certainty. A bank syndicate for a complex merger would have taken months, with last-minute retrading on terms, a risk Thoma Bravo could not afford. The deal fails if underwriting was too aggressive. If Thoma Bravo's projections for synergies and cost savings prove optimistic, the covenant light structure, which some view as a benefit, can mask the deteriorating of credit until it's too late. And if refinancing markets close before exit, The lenders hold the loan longer than anticipated, which exposed them to unforeseen risks. Let's compress everything into three bullets. Structure: a $4.8 billion unitranche facility, privately negotiated between Thoma Bravo and a group of 33 direct lenders, with Canyon Partners as the lead arranger. No banks, no syndication, one loan. Return: a floating coupon of SOFR plus 575 basis points. Origination and exit fee push the total lender IRR into the 12 to 15% range. And finally, the real takeaway. Private credit isn't just lending money, it's about speed, control, and execution certainty. Banks are slower, banks syndicate, banks retrade. In 2026, for a $4.8 billion merger, Thoma Bravo chose zero banks.